Welcome to Brookfield Perspectives, a podcast that explores the Brookfield ecosystem's role in creating sustainable wealth on a global scale. On this episode, Lowell Baron, Ben Brown, and Brad Hyler, three of our senior real estate leaders, talk about recent market dynamics and notable activities since our last update, including the state of the business today and the forces driving our investment strategy. Here's their conversation.
So hi, Brad Hyler. I'm a managing partner overseeing our European real estate business and co-president globally. I'm now 15 years at Brookfield, spent the first roughly 5 in New York and been in Europe since then in London. Always good to be back in New York with Ben and Lowell, longtime colleagues, and looking forward to the conversation.
Yeah. Hey, guys. Hey, everyone. Ben Brown here. I lead our real estate business in the Americas, also co-president of our global real estate business. Also been around Brookfield for about 15 years and headquartered here in New York.
Hi, Lowell Baron, CEO of our real estate business. Great to be here with you guys. I've been with Brookfield a little longer than both of you, so 20 years now, which is hard to believe, but it's great to sit down now and rehash where we see the market environment, what's happening on the ground across the globe, in our markets, in our sectors. And really, we did this maybe 18 months ago in a relatively formal setting, just talking through what we saw. I think it's good to update. At that time, we were saying this is probably one of the best investing environments we've seen in a long time. Why don't we start there? What do you guys think? Have we been right? Is that what we're seeing over these last 18 months?
I'll start. I think in the moment, it never feels as obvious or as right, but it still feels really, really good. It still feels like there's enough volatility and uncertainty, which creates a tremendous amount of opportunities for us across our business globally. But it definitely feels like markets have improved. And when I look back at the activity that we've done really across the entirety of our real estate business the last year, it feels like we've accomplished a lot in what has been a relatively difficult environment. So I would say, yeah, on balance, it still feels really good.
I think it's mostly played out, but maybe with some fits and starts. It hasn't been a straight line. Things have certainly improved in terms of the volume of transactions over the last 18 months. And certainly there's capital that's come back into the sector. We've obviously had some success in wrapping up our last fundraise, but I think things picked up towards the end of last year and the beginning of this year, but then another bout of uncertainty globally with geopolitics threw things sideways, at least for a couple of months. And now maybe things are starting to open back up again. As you said, Ben, we've had some success in monetizing a bunch of large businesses in very select sectors around the world. We've continued to deploy capital, maybe not quite at the pace that I would have expected 18 months ago, because that bid-ask spread is still there and persistent, and general level of uncertainty is holding back a bit of the activity that we thought would come through. I think we still expect it to come through, and the back half of the year should pick up in pace, and I think be a lot busier than maybe Q2 was, by example.
Yeah, I might pick up on that because I think it has played out as we thought, but probably what's been most surprising to me has been, it's been a pretty slow recovery. Normally you think as capital starts to come back in, people see that the fundamentals are good, and then you expect that capital builds, and then quickly you see pricing recovering and transaction market recovering, and that's happening, but very slowly. Actually, it's fantastic as an investor. It's a great time because sometimes you worry that those great periods of time are too short. But here we've had a good runway, and I think it continues for a while, which is allowing us to put capital to work in really attractive ways. And I think that volatility in the market will continue to make this time a good opportunity, particularly if you can be global and you can move around the markets and do different sectors and different regions and really be dynamic in where you see the opportunities. That plays to our strength.
Yeah. And that feels like what we've definitely seen the last year, where really now across the globe, whether it's in our business in Asia Pacific, our business in Europe, or even now North America, which probably felt the last couple months maybe the least liquid, we've done really large transactions in terms of exits. And that's just proven around the globe for the right kind of business, the right kind of assets, with the right kind of business plan, there's still meaningful amount of capital and depth of that capital, and that's good. Where there's not, that's where we've been spending our time trying to find opportunities. And so it is an interesting, pretty dynamic environment in that way.
And all the ingredients are still there. Asset values have repriced, so that's a positive as an investor. Supply, I think we're seeing everywhere in the world, is muted and dropping, which is good. We're able to buy well below replacement cost. And you still have all these stressed and motivated sellers. It's the case, I think, where lenders have been somewhat cooperative with owners to allow them to have some time. But that pressure continues to build, and it's still the same thing with redemption queues and end of life of funds. So we're seeing stressed investors out there that ultimately do need to sell or transact, and that's creating all these good opportunities.
Yeah, the volume of assets that need to rotate and recycle continues to build. And the longer that delay happens, the more pressure it feels like is in the system and will ultimately come through, where sellers are going to be forced to take a clearing price that they've been resistant to over the last couple of years. And that's starting to happen, but it feels like could pick up pace as we get into back half of the year and next year.
We've been saying now for a long time, hope and waiting is not a strategy. That's coming to bear out. Time is just not creating the catalyst for people to sort things out, whether it's broken capital structures, over leverage, lack of capital to continue to invest. And that's great because that means we can buy really good businesses at good value and we can take advantage of that business plan that we can execute because we do have that capital.
I think what's interesting is we're seeing that recovery. So if you look at our activity, we've invested about $6 billion of capital over this first half of the year. That compares to what was $3 billion at the same time last year. So we're already doubling in our activity. Probably the place that's even more notable would be on the disposition side, where we've sold $13 billion of assets in this first half. And if you look back at the first half of last year, that would have been about $3 billion. So major growth in our sales. Maybe we should talk a little bit about that. And what I would just broadly say, then maybe we dig into some of the examples, but broadly say on disposition activity is that the market is incredibly bifurcated and we're seeing it when we sell. So we have two places that there's capital interested in buying assets. It's either portfolio companies that are best-in-class operating platforms, and that's where we're having a lot of success selling, or it's single asset, small portfolios. The whole middle, large portfolios, I'd say is still a place that you're seeing very little activity and very little capital chasing. But maybe it's worth, Brad, I don't know if you want to mention Lavenza as just an example of what we're seeing out there when we're going to sell a business like that and how we're executing on it.
Yeah, so Lavenza is our Spanish student housing business that we first started to acquire back in 2019. Went through COVID, obviously disruptive, but student housing generally came back pretty strong post-COVID. And I'd say in Europe, over the last couple of years, the periphery in Southern Europe and the non-core countries have actually outperformed the core, which is different than certainly the last decade. And there's been a lot of momentum around Spain in particular. The interest rates have come down there, inflation's come down, rates in Europe have come down. Yet there aren't very many ways to invest in market rate residential generally, and student housing is certainly one of those ways. And there aren't many large freehold operating platforms in scale where you can do that. So we built up a business. We felt like it was the right time to bring it to market. And we had a pretty competitive process with a number of well-capitalized institutional investors and sponsors. It went through the April period of disruption in terms of the process and what was happening in geopolitics, and that thinned it out a bit. But it still ended up being a fairly competitive process, and we ultimately exited at an attractive value and return for our investors because an institution could come in and buy a plug-and-play business where they continue to invest capital, continue to compound returns in a sector that had lots of tailwinds and attractive fundamentals. It was the right market at the right time in the right sector, and a business that was scalable.
I do think that's an important point because what we're really selling then to the next buyer is not just assets, but operations. I think one of the key themes in this environment is having to have operational expertise and excellence. It's not like real estate 20 years ago. You can't just own an asset and clip a coupon, and that's how you make your returns. It's all about how do you execute business plans on the assets? How do you create revenue growth? How do you renovate and reposition assets? How do you manage expenses? All of that. So when we're selling these operating businesses that have that full team that we've helped build and create, the buyers are interested in buying that. It's interesting on that point. Lavenza, which we created in 2019, pre-COVID is when we started it. Lilo, which we just exited our luxury India hotel business, we started pre-COVID. Aveo, which is our senior living business in Australia, which we just exited, we built that up also pre-COVID. So all of these that were pre-COVID, that were impacted directly by COVID, have all turned around, have all turned into very attractive opportunistic returns for our investors. And it all is because of how we operate those assets. So the theme is very strong. And I think it just goes to tell you who are the investors today that are going to have success. It's the ones that have that kind of expertise.
Particularly in scale for larger things. The institutional investors out there that are deploying capital in scale are still looking for relatively high returns, at least compared to the last 10 or 15 years, versus selling smaller assets. Single assets are more core-like, where there are more yield-focused buyers at lower returns. But for the larger things, they're looking for that opportunity to invest in platforms that they can grow and keep compounding.
Yeah, I think you hit the nail on the head when you said the ability for them to buy something they can continue to invest in. We've seen that on all the exits you just described, including fundamental income properties, our triple net lease business that we sold just recently this year. It was another business that we built really right on the heels of the onset of COVID. What we all know today is tomorrow is a little unclear. There's still volatility, there's still uncertainty. But in the fullness of time, you know that you can take these businesses and invest capital in a creative way and continue to grow revenues or reposition assets or bolt on further investments to build out that platform in even more scale. We're really seeing investors put a real premium on that. And I think we've been rewarded for that through all those exits.
Yeah, I want to also talk about the environment for fundraising, for capital formation, because I think that also goes to when are we going to get these wheels of transactional activity happening? It's when there's capital that needs to be invested. We had our success. So we spent a lot of time over these last 18 months with our investors and fundraising, and we've been luckily very successful and fortunate and raised our largest fund ever for our opportunistic strategy. But at the same time, we're watching a lot of these mid-size and smaller-size sponsors that are having a tougher time. And I think we're seeing the market in general, capital, is headed towards groups like ourselves that have the scale, have the ability to diversify where we invest, have the operational expertise. And that's leaving a lot of people behind. That's becoming an interesting investment opportunity for us too, where we can think about things like GP-led recaps. It's an interesting strategy that we're finding a lot of success in because of that.
Yeah, the dynamic you just described is sort of the perfect storm for this environment of these so-called GP-led secondaries or recaps, where you really have, in many cases, either in a closed-end strategy that is at maturity of its vehicle life and or LPs who want a return of capital and need a return of capital. So what we've started to find is this point of inflection where there's an ability to be a solutions provider. And that is to come in and provide the solution for the LP who wants to exit and the GP who wants to continue to find ways to continue to create value through those portfolios. And in many cases, be able to frankly scale those portfolios or those businesses. And it's perfect for our business because we can really understand the assets because of the scale and the breadth of our operating businesses internally, but we can leverage people that are sharpshooters in a specific sector or geography, utilize our scale and frankly our capital to help them grow. And it's been a really great marriage where it's opened up another breadth of opportunities for one of our strategies. And I think we found a tremendous amount of success in that pretty early days.
I'd say it's surprising to me. I think when we first went into that space, we didn't fully understand what level of opportunities we'd find. But with these sponsors really wanting to hold on to their assets, we can help provide that to them. It creates really attractive investment opportunities for ourselves.
And it should keep picking up. If you go back to 10 years ago, where there was a lot of capital raised in that middle market that's now hitting into fund life, and the slowdown in the transaction market over the last couple of years, again, it just keeps building in terms of volume of things that need to rotate. So it feels like there's going to be more opportunity in that strategy over the next couple of years.
Yeah, absolutely. And look, we're in an environment where it's fantastic, the fundraise that we've had and the capital that we have at our disposal. But we all know that was hard. That was a challenging environment to do that in. And there is continued, I'd say, headwinds and probably compression in that space for a lot of managers who are going to have a more difficult time. So that'll lead to more of our secondary transactions. But frankly, it'll lead to more consolidation with people that have a global business, operating expertise, and scale to keep finding these opportunities where before there may have been more sources of capital. It's starting to get more difficult to find. That gets me pretty excited at the next couple of years of the kinds of opportunities that we're going to see.
And we've been talking a lot about equity investment opportunities. I think credit also is a place we should talk about because certainly been in the headlines. Everyone's talking about the private credit opportunity that's out there and that's growing. And we're certainly experiencing it here at Brookfield. Real estate credit also feels very good. We're able to come in at these reset basis, reset values for real estate that we're lending against, which gives you extra cushion. The base rates are good. Spreads in real estate are higher than they are in corporate. So relative value, relative return is high. I think credit is going to be a pretty good growth opportunity and a good place for people to invest their capital for the coming years. I don't know what you guys are seeing.
Yeah, look, there's certainly a lot of deleveraging and refinancing that needs to occur, just given how active the period was, again, going back, whether it was 3 years ago, 5 years ago, 7 years ago, that wall of maturities that everyone talks about, most of that gets refinanced and the banks are retrenching and private capital is there to step in. And we can and we are playing a big role there, given we've got the equity teams to understand markets, understand sectors, do the underwrite. And oftentimes things we're looking at on the equity side where we don't quite feel pricing's right for the equity, but we're very comfortable at where the detachment points are on the debt and make very good risk-adjusted returns.
Yeah, I think that part of it, which I don't think any of us really thought about as we were investing in these spaces, but once you have same teams working on really across all of it, all the capital stack, you can really think about that relative value. I want to also talk about Office US for a second. Office in the US, we've said it for a long time, it's very bifurcated. The highest quality assets are doing well. From where we've been, at least lately, watching the opportunities, credit for office seems like it has the higher, better relative value. It's more interesting to us to lend in office, and there's really very few people doing it, so it gives us extra return. Whereas equity, outright equity, buying an office, I don't know about, what do you think?
Yeah, look, I think that's spot on. We always say when others are fearful, that's when you should be investing. And I think that's office in a nutshell. We've seen firsthand over the past 5 years, as you said, the bifurcation of performance. It's actually pretty easy now to understand the haves and the have-nots. So if you can focus on the haves and you can understand the assets that will continue to have net absorption, that have good positive net effective rent growth, you can identify those. And office is a humongous sector. So it's actually a relatively large opportunity set. And today, as you said, banks are retrenching from commercial real estate. Let's say that's table stakes. They're definitely retrenching from office. There's many other things that they would rather do on their shopping list than office. So today, when you look at relative risk, both in what you can earn, equity investing in other sectors, versus credit where values have been reset, okay, so that's good. Real fundamentals have transparency in terms of demand. There's real cash flow happening now at these assets, and you can insert yourself at a relatively senior ranking, very protected position and earn historically high returns, taking very little risk. The added benefit is because we know almost all of these markets and frankly, many of these buildings floor by floor, we really have a good ability to assess the risk within that rent roll and really pick our spots. And we're seeing probably a mispricing on that, where we can look at some that carry what we would say a tremendous amount more risk and others that we would say are great assets. We would buy them at a value. Maybe they're not available to buy and they're just available to finance, but we're getting paid for that. And I think there's excess spread and excess return in office today in credit.
On the topic of sectors, we've been saying for a while rental housing is our highest conviction. I throw it out to both of you. Still the case, and why?
Yeah, it's certainly among the highest conviction. Maybe I'll just take Europe, whether it's student housing, as we talked about, senior housing, manufactured housing, single-family rental. A lot of them are relatively nascent and are just now developing. The demographic story in Europe is there. So in building these platforms and creating these operating companies, we think is going to be a great opportunity going forward, just given the shortage generally of housing across the continent.
It gets hard to deny the supply and demand fundamentals of rental housing broadly in the Americas. And the funny thing is, when you say rental housing, we're not just talking about apartments. There's a broad swath of rental housing typologies, everything from traditional apartments to manufactured housing that we like a lot, senior housing, student housing, and single-family rental. Clearly, they all have slightly different nuanced demand drivers and slightly different nuanced supply outlooks. But I'd say on balance, as you said when we started, we've crested the peak of supply in almost every market, at least in the US, and we still need more housing. So it will take a long time for that supply to build back up and the number of dwelling units that we actually need to be delivered. So the supply side feels really good. We're still in a high rate environment. Even if we get a couple of rate cuts this year, mortgage rates likely aren't going to fall a tremendous amount. Home ownership availability continues to be out of reach for most Americans, and that just continues to build a larger and larger rental cohort. And that's a long process that will take a long time to work its way through the system, where home ownership becomes a affordable metric again relative to rental housing. So for all those reasons, it's really hard to say, yeah, I'm convicted more about something else. I would say there are some other sectors where they maybe feel more dislocated, but clearly with that comes some risk premium. So rental housing is pretty undeniable in my mind.
I just got back from Brazil last week, and it was fascinating to just spend time in our multifamily business that we're building there.
Yeah.
Now, that's an extreme example of where there's so little inventory, and the demand is just where buildings get delivered to us, and we're fully leased within 4 months. That demand for rental housing continues to grow, and Brazil is one example, but really all around the world.
And even the areas in the U.S. that did have some excess supply going back a few years ago when, call it the development pipe was running, those have mostly been absorbed now.
Very much so,
and have returned to stabilization, broadly speaking, you'd say.
Yeah, and look, we all know, because we look at it every day, the feasibility to start new construction is pretty far out of reach. Hard to get construction financing. It's expensive. Development yields really don't justify new construction. So I just think that dynamic perpetuates for longer. So it should spell really good growth across, I'd say, all of those typologies really on top line revenues.
The other thing that was obvious to me, and seeing, I just go back to Brazil for 1 second, the multifamily in Brazil was the blurring of lines between multifamily and hospitality, particularly because of technology. In that case there, the ability to really optimize your mix of residents between short-term, mid-term, and long-term, and doing it all through essentially automated software that we built that allows for optimal pricing, optimization of net operating income. On that topic of technology, I just throw that also out to both of you. Are you seeing technology have a real impact on our real estate business, and in what way would you describe that?
Look, I'd say the biggest is what you just said. It's yield management and figuring out how to drive higher revenues by leveraging technology to figure out how to actually get the highest paying customer in the space. And whether that's short-term, long-term, somewhere in the middle. Obviously, hospitality and residential are the most relevant. But the way we run our buildings all over the world, I think we're far more efficient in running them at higher margins today than we ever have been, just using all of the technology that's available. You probably see it most in the office portfolio and at least building systems in the US, but I'd say it's pervasive across our whole portfolio.
Yeah, I might add to that question then too, which is the question I'm sure that all of us have gotten a million times now. AI. How's AI impacting us in real estate?
So maybe it's just a continuation of that answer, which is when I think about our real estate business, any sector or really any geography, like we're in the people business. We're selling people an experience on their vacation through our leisure. We're selling people dwellings and their homes, and we're selling people an office experience, and we're selling people a retail experience. And now through AI, where we're just on the bleeding edge of really understanding the power of many of these tools and the generative AI tools, what we know about our customers, and our customers could be the person working at the large financial institution in our office that comes here every day, that then goes downstairs and shops and then leaves and may rent an apartment from us and then goes on vacation and is a hotel customer. It was very hard in the past to knit all of those things together, and they were very siloed. And we sort of knew broad brush where demand was and who our customer was. Now we really, really can utilize AI to understand usage, demand profiles, customer acquisition costs. We're starting to think much more, I hate to say it, like how technology companies think about acquiring their customers than old line real estate businesses think about leasing space. And to your point on yield optimization, the ability to really understand that. I think our model in Brazil is fantastic. And I think we've gotten there almost by accident, where the system we were using was really to leverage short-term stays. And then we started to yield medium-term stays. And now we can find the right pie chart and balance of long, medium, and short and really optimize. You take that and extrapolate that over the next couple of years when these models get better and better, the global business. And then you think about the broader Brookfield, what we understand in our operating business and private equity, what we understand in our infrastructure business. Man, when we can harness that, it's going to be an absolute game changer. So we're starting to see it. I'm pretty excited about what I think we can actually do with it.
Like, I think where we're going, and it's probably not too far off, is really into these predictive analytics, which is then taking advantage of all the data that's out there that's third party and that we have access to, but then add to it all of our data across our $300 billion real estate portfolio and across our $1 trillion asset management portfolio across Brookfield. And what do we know about markets and micro markets and businesses, and be able to use that to actually predict which markets, which property types, what should we be investing in? And we're just starting to see it in things like our single family rental, where we are picking our markets, or in some of our logistics, where we're also same thing into picking which markets we see better than anyone else, where the growth is going to come from and how much. We're just at the start, and that's going to impact our business and real estate broadly, I think in a big way coming, and it's not that far off.
There's no doubt.
So we talked a lot about where we are, but I guess the question is, where are we going? What are you guys most excited about? What do you see as the big opportunity for us going forward?
Well, it would be hard not to include data centers and the growth in digital real estate that is happening and is going to happen over the next decade. The numbers are extraordinary. And what we found is that we're actually already sitting on a lot of the raw material, which is the sites, things that we've acquired over the last number of years for other uses, mostly logistics, but in some cases, residential development or science parks, where we are now working with our colleagues on the power side and our renewables business, as well as our infrastructure business, who have data center developers in-house and have these really long relationships with the largest hyperscalers in the world. Bringing all of that together is really exciting. And to see the power of Brookfield at work across all these different disciplines to capitalize on what is going to be the largest capital investment cycle that we've seen in a generation, clearly. It's going to be pretty unique. Not everyone's going to be a winner in this space, but I think given our setup, our history, our relationships, we're extremely well positioned. And to see it all come together has been pretty exciting.
I don't want to overstate it, but this is a dynamic where it feels like everyone just got to the party and we've been standing around like we've been here. We've been investing in data centers in our broader business for the better part of 14 years. Everyone's woken up. It's a very different business now, and the users and the quantum of compute and power and demand and dollars that will need to be invested are much different than they were 5 years ago. But to your point, it's kind of amazing in our business where You look at our land and housing development business, our traditional real estate logistics business, infrastructure, et cetera, where we have so many tethers into controlling and owning land, having access to power, having a relationship with the end users. It's hard to see how we don't have a huge competitive advantage there. And to your point, there's always a lot of exuberance around these things, and not everyone will get it right, but it's pretty exciting dynamic when you can knit together all of those different businesses that have a unique know-how, source of capital, source of power, control of land, put those together and create these projects. It's fantastic. And we're doing it in Europe and we're doing it in the US and we'll do it globally. That's going to be a great engine of growth for our business.
Yeah, I have to fully agree. I think it's a huge opportunity for us. And everyone's sort of aware of it, but not too many people can do it, which is what makes it so interesting. And I do think there's going to be a number of people that stub their toes, or maybe worse here, because it's a bit of a gold rush. But if you don't have all those capabilities, you will make a mistake. And you go in and you say, I'm going to go develop this, and I think I have the power, and then I don't have the power. That's a fatal flaw. There are people, things we're watching that I think won't end that well. But having all those capabilities that we have and put it together allows you to do it in a way that's pretty risk averse, which is fantastic. Ben, what are you most excited about?
I'll answer it maybe more broadly than specifically one of our markets or sectors. Maybe what I'm excited about is what also keeps us up at night or has been challenging over the past couple of years, which is we continue to live in this world that has a tremendous amount of volatility, really a shifting and changing dynamic, whether it's geopolitics or global trade or capital flows. But I get really excited about all that dislocation because we've got a lot of dry powder and a lot of know-how and a lot of areas where I think we can exploit that. So I'm pretty excited about the fact that it's not clear what's obvious. It's not clear what the best investment idea is. We'll figure it out and we'll build conviction around it. And we're doing that. And I think we have been doing that. But these sorts of environments, we were talking about this yesterday. Post-global financial crisis, we were all sitting in some similar role here, working together, and everything we were doing, it felt pretty difficult and it felt pretty uncertain. And when you look back, of course, the fullness of time and with hindsight, you went, wow, we bought amazing businesses, we bought amazing portfolios, and look what happened. And we learned a lot, and we built great businesses, and we built expertise. I think this is that environment now where we'll look back 5, 7, 10 years and we'll be like, we got into this sector. We doubled down on this trend. We really saw something and we built the engine of growth for the next 5 or 10 years of our business. I think that's now. So it's just the environment right now is what's exciting.
Yeah, I agree. If I were to say where I think we are, I think we're in the second inning of a new cycle and a new recovery. So that's exciting to be at the early stages. The other thing that I think will become clear as the dust settles over what has transpired in the last 5 years in real estate, been a really tough 5 years for the sector, for the industry. Gone through a lot. COVID, huge disruption, then interest rates moving like they have, geopolitical volatility, all of it. There's been a lot going on in this world in the last 5 years. And when the dust settles, we'll have done quite well. We will have come through this in a very strong position. We've made the right investments. We've diversified our portfolio as well. Part of what I'm excited about actually is being able to see that in facts and in numbers. And we're seeing it now as we're doing all these exits. You talked about Lavenza. I might mention Aveo in that same regard. Aveo, we bought this senior living business in Australia in 2019. You probably couldn't have timed it worse in retrospect. And the whole premise was to take a public company that was dysfunctional in terms of management, take it over, bring in new management, turn it around. And suddenly we get hit with COVID when we didn't even have a management team. And we're trying to figure out how to manage senior living assets where they're probably the most dangerous place. Honestly, it was scary that we were in charge of this and in charge of people's lives. Now you look back at how we turned it around and brought in a whole new management team and protected our residents and created an incredible brand name and quality of portfolio and turns it into opportunistic returns. It's fantastic. And it's just indicative of a lot of these businesses that we've built. So we're going to come through all of this with flying colors, and that just will power our business. We see it already and our investors voting with their feet and putting their capital to work with us. But I think that's just going to grow from here. Why don't we wrap it up here? This is a great conversation. Really good to do it. Thanks, Brad. Thanks, Ben.
Yeah,
Always.
Thanks.
This podcast is for educational and informational purposes only and does not constitute an offer to sell or a solicitation of an offer to buy any securities or related financial instruments offered or sponsored by Brookfield. The information and views discussed are subject to change without notice. Any investment involves significant risks, including loss of the entire investment.